Today, I'll be talking about free cash flow. Free cash flow overlooks accrual accounting, which is used to calculate the net income of a firm, and instead gives a true picture of the company's cash inflows for a given period. On the other hand, accrual accounting reports revenues and expenditures as and when they were incurred, regardless of when cash changes hands. Free cash flow is essentially the cash available after a firm pays for its operating expenses and capital expenditures. There are broadly two types of free cash flows: free cash flow to firm or FCFF, and free cash flow to equity or FCFE. FCFF is the cash flow to the company after the company makes obligatory debt payments. Companies are obligated to make debt payments, principal or coupon, before they give away cash to its shareholders. FCFF is the after tax operating income minus the sum of net capital expenditure and the net change in non cash working capital. Meanwhile, FCFE is FCFF minus net borrowings. FCFF weeds out many accrual based or non cash items like depreciation and amortization. FCFE, meanwhile, is the free cash flow to shareholders, that is, after all the debt payments, if any. Free cash flow is the main component of a discounted cash flow or DCF valuation of a company. Current free cash flows are often used as basis for assumptions for future cash flows by using cost of equity or cost of capital to arrive at the intrinsic value of the company's shares. Hence, free cash flow is a key input for value investors to determine whether or not the stock is undervalued. Free cash flows are often preferred over net income as they are less cryptic compared to net income, which is subject to more accounting discretion compared to free cash flows. Hence, some investors prefer using free cash flows over net income, as the former disregards all non cash items. That said, capital expenditures tend to be lumpy, meaning not consistent, which usually makes free cash flows more volatile than net income. Free cash flow to equity or FCFE can be construed as the amount a company can afford to pay in dividends and share buybacks. Companies with high FCFE usually reward shareholders with dividends and buybacks. For example, Apple has seen its free cash flows surge over the years. The company has rewarded its shareholders by paying back hundreds of billions of dollars in dividends and buybacks over the last few years and still has an extremely high cash balance which will serve it well during crises. Free cash flow includes changes in working capital. Hence, it can provide valuable insights into the strength of a company's balance sheet. Let's say a company is seeing higher accounts payable. This could mean that the company's bargaining power with its suppliers has increased, leading to better terms of trade. Similarly, an increase in accounts receivable could mean that the company is losing its bargaining muscle, maybe due to higher competition, and as a result is collecting cash from customers later than usual. An increase in inventory, on the other hand, could point to an accumulation of unsold products, which suggests weakness in business. These are the key working capital changes that a company usually sees and are all critical insights which the net income does not provide. Whether the company has been able to reduce the change in working capital over the years or not is a telling insight about the position of the company against the creditors and clients. Typically, free cash flow and net income move in similar directions or towards each other if there is a difference. However, if the two metrics seem to have a low correlation with each other over several years, that's a yellow flag. It indicates that the company is not able to convert its capital expenditures into higher earnings. The chart shows how Apple's net income and free cash flow to firm have moved in similar trajectories. Meanwhile, streaming giant Netflix has been spending billions of dollars on content acquisition cost, diminishing its free cash flow while its net income has surged. If the divergence between cash flows and net income does not go away over a few years, that is a bad sign for the company's stock. The current assumption is that the company will be able to grow and generate income even after it stops spending several billions of dollars on content. Historically, the S&P 500 index has moved almost in lockstep with free cash flows and net income of its constituents, which drove valuation. However, in the last few years, due to the surge in rules based and passive investment, massive stock buybacks, and the incredible pumping of liquidity from the Fed, there has been an unprecedented disconnect between free cash flows or earnings and stock prices. The S&P 500 index has surged as the graph shows, but not in perfect lockstep with earnings or free cash flow. Whether this is a permanent shift or stocks will revert back to fundamentals will be known in a few years' time. In conclusion, not only is free cash flow a critical input in valuation, it also tells a lot about the company's position with its creditors and clients and whether or not its capital expenditure is yielding good returns. Thank you for watching.